So till now we discussed about the computation of total cost. So where we calculated, if you remember, we calculated the total material cost, then total labor cost, then indirect or overhead costs, and from there we derived that what is the total cost of a product, right? And then we discussed that how the marginal costing, the CVP analysis, concept of relevant cost we can use for making the decisions, right? Now, after calculating the total cost and then after taking the decision and implementing those decisions, the next stage is the performance evaluation and control, right? So, we have calculated the cost, we are producing something, we have calculated the cost and we have taken decisions to improve our performance, to reduce the cost. We tried to take, the right decision at the right point of time. But after some time, we also need to evaluate that the decisions which we have taken earlier, right, whether it is impacting our performance positively or not, and what is the feedback, right? So there is a feedback loop. So based on the feedback, then we can again modify the decision making process, the cost calculation methods, and all. So it is a continuous process which goes on, right? Now, this monitoring and control, that is an important part of this process. So, there are two very important tools which we will discuss as far as the monitoring and control is concerned. The first one is called the standard costing or variance analysis, and the other one is the budgeting, right? They are interlinked with each other. With some difference, their objective is slightly different, right? Way of calculation is slightly different, but both are very, very important tools for performance measurement and monitoring and control. Now, let me give you a brief introduction about the standard costing and variance analysis before we go into the detailed technicalities, right? The concept is what? The concept is that suppose the company is producing some product, right? It is using, say, three basic components for it. It is using material, it is using labor, it is using overheads or indirect costs, indirect expenses, fine, for production, right? Now, I need to make a plan for that, right? So, say I am taking up, say, material, right? So, I have a production plan. I must have a production plan. This production plan may be a function of the market demand, the capacity which I am having as a company, right? The factors of production availability. So, based on these things, I made a production plan. So, I said that I will, during the year, I will produce, during the forthcoming year, right, I will produce this much. Now, once I made this production plan, I have to make a plan for the production factors also. Say, for example, I need to estimate that how much raw material I should procure in the forthcoming year, so that I can meet these production plans, right, I can execute these production plans without any bottleneck, right? So, when I am doing this, I need to take care of, say, what is the price I need to pay. So, next year I am planning for, say, 10,000 units of production. So, for 10,000 units of production, how much raw material I will need? What is the raw material need per unit, right? And for procuring this raw material, from where I will source, who are the suppliers, right, who will supply me this raw material and at what price, right? So, all these things I need to plan, right? And while doing this, I can keep a standard, like I can say that this raw material per unit, it should cost me 10 rupees per unit, right? That is my standard, right? How I will arrive at the standard? I can take the quotations from the supplier. I can see what competitors are doing, at what rates the competitors are procuring their raw material. So, based on that, what is the transportation cost, right? So whether I can perceive some problem, and I have historical data also, I can take historical data and I can fix up that, okay, 10 rupees per unit should be my standard raw material cost, right? So this will give me an idea that how much spend I may have to make next year, right? Ideally, under ideal situations for this. Now, when actually I started producing, right, my raw material cost may not match exactly with the standard cost. In practice, in reality, it usually doesn't match. It may happen because of several reasons. The reason is, in reality, the real world is not, doesn't always function, in an ideal manner, right? I can give you, there can be some normal disruptions, there can be some very rare but severe disruptions. Like for example, at the time of COVID, right? Many companies, they faced a severe raw material shortage because of supply chain bottlenecks, because the entire world became standstill, right? And no transportation, nothing, people were all inside. So they started, facing raw material crisis, right? Automobile companies, face severe, particularly EV manufacturers, right? They face severe shortage of semiconductors, which is an essential component of EV. So this thing, but these are all, extreme cases. But in normal times also, maybe because of political unrest, maybe because of natural calamities, or maybe because of some mistaken assumptions also, it is possible that your actual price of raw material and the standard price which you considered, right, as ideal, there may be a mismatch, right? It may not match. Most of the time it doesn't match, right? Now the thing is that if this difference is called variance, right? Variance between the standard and the actual, right? Now, if this variance is within the acceptable limit, the problem is not much, right? We can see that why this is happening, and we can take remedial actions. But if this variance is too high, right, then the company may have to relook its strategies, right? Now, this variance may be favorable as well as unfavorable. Favorable means what? In case of cost, if we talk about the cost variances, say material cost variance. So I assume that my standard material cost per unit should be 10 rupees, right? But actually when I produced, I found that it is 12 rupees, right? So it is higher than 10. So I can say that my material cost variance is 2 rupees adverse, right? On the other hand, my standard material cost variance is say 10 rupees, but my actual cost per unit of material is 8 rupees. So it is, actual cost is lower than the standard cost. So I can say my cost variance, material cost variance is 2 rupees favorable, right? Now, as I said, that if this variance is small, right, we will look into it, why it is happening, but it may not be a very big matter of worry, right? But it can be worrisome if this variance is large, right? If the variance is, huge. Now, in this case, there is sometimes there is a misconception that favorable variance is good, right? Adverse variance is not good, but favorable variance is good. But here I want to mention that any type of variance is actually not desirable, right? Even if it is adverse, of course, without any reason, if it happens, right, that is quite a serious matter, right? Because if my standard material cost is, I am assuming that it should be 10 rupees, and accordingly I made my pricing. The pricing I declared already, right? Pricing has to be declared beforehand when I am making the quotations. There I assume that my material cost will be 10 rupees. When I am producing, it became say 13 rupees, right? 3 rupees higher. So almost 30% higher. So where I will absorb, because I can't tell my customer that, okay, you see my material cost has increased 30%, so you increase your rate. That I can't say, Fine. So it can seriously dent my performance, my profitability, the long term, prospect of my company. But at the same time, the favorable, uh, variance is also not always good. If my assumption is that my material cost will be 10 rupees and if my actual cost is 7 rupees, that means I am lacking somewhere at the planning stage itself. I have not foreseen that from where the benefits would have come, right? So that shows a kind of weakness in the planning stage itself, which is not good, right? What I want to say is that anything, whether it is favorable or unfavorable, if I can't perceive it beforehand, right? If my anticipation, or predictive capability is not matching with, is not performing well, right? That will impact my uh, performance in the longer run, right? So, this variance analysis, it is a simple but very useful tool to understand the particularly the weak links into the system, right? So, I can calculate the variance and for all the cost factors. Primarily what we will discuss is on material, labor and overhead. We can also see the variance on the income side also, like we can see that what is the variance on the sales, right? I predicted that my sales will be 10,000, but actual sale is 12,000 or actual sale is say 7,000. So, why this gap is there? One thing I would like to tell here, that calculation of variance is one thing, right? That is one part, right? But what is more important is having an insight that why this variance is appearing at all, right? So, some introductory concepts we will discuss in this course. Like for example, I am giving one example. Say, I have observed that there is a variance in the material cost, right? I planned for some material cost per unit, but my actual material cost per unit is different, right? Now, how it can happen, right? So, when I further dug down into this factor, I found that it can happen because of say two reasons. One reason is the cost, the price of material per unit which I anticipated, which I perceived, that is different from the price which I am actually paying, right? So, if the situation is that the price which I perceived, I planned for, and the actual price which I am making actually, that is different, then we need to really investigate that whether this difference is happening because of something which is beyond our control. Is it happening with only us or it happened with our competitors also, right? And next year when we will do again new contracts for material procurement, do we have to negotiate well in advance? So, all these factors I need to see into as a manager, fine. Similarly, we found that the price is okay, but the usage factor, right, when the material is coming to the factory floor and it has been used for production, then there the wastage which I perceived as a manager, the actual wastage is different, right? So, manager perceived that the wastage will be 10%, but actual wastage is 15%, right? So, again it gives me an insight. As a manager, we can get an insight into it. So, if it is happening, the wastage is varying, why it is happening? Is it a recurring event? Was it not happening earlier, right? Is it a new phenomena, right? If it is a new phenomena, then what is the reason behind it? Is the reason is that the new workers who joined, they are not skilled enough, they need training, they need upgradation training so that they can use the material in a more proper way and the wastage can come down? Or second is, are the machineries have become old, because of that wastage is happening? Is there any need for replacing the machineries and technology with the latest one, right? So, this kind of insights we can get from the variance analysis, right? And these insights are very, very important. Okay. So, we can calculate all these variances and see where are the red flags, where it is acceptable, and accordingly we can take further action. And if there is any, we find that there is any lacuna, any drawback, any weak link in the decision making process, then we can take appropriate actions. Here the more, the calculations can be done, right? Calculations, there are ways we will discuss. There are formula, there are equations you can apply and you can calculate the variances. But what is more important is when you are getting the figure, how you are looking at the figure, right? And how you are analyzing those figures to get into an insight and take corrective actions for improved functions. Okay. So, we will now move into the calculation part. So, just before starting the definitions, standard cost. Standard cost is the predetermined cost based on the technical estimates of materials, labor and overhead for a selected period of time for a prescribed set of working conditions. So, you see there are certain things are written here, assumptions are written here. Assumption is selected period of time, right? Over the longer run, standard cost changes. So, over year and year along the year, the standard cost cannot remain the same. So, it changes, right? And second is the prescribed set of working conditions. Prescribed set of working conditions means if the working condition changes, the standard cost also changes. If I change the technology, for example, right? If I change the machineries, right? If I train my workers better, then my standard cost can change. So, that is why the companies spend lot of money on training the workers, right, making them more aware, right, and improving the working conditions, right. So, standard cost improves with that. So, suppose if you now AI is coming, right, AI can be very helpful in official work. So, if the employees are trained using AI for enhancing the productivity, the cost can come down, okay, and then standard cost can also come down. So, these factors are, this is a continuous process. Standard costing definition is what? The preparation of standard costs and applying them to measure the variations from the actual costs and analyzing the causes of variations with a view to maintain maximum efficiency of the operations so that any remedial action may be taken immediately, right. So, this is a standard definition of standard costing. Cost variance, as I said earlier, difference between the standard cost and the actual cost, right. Standard cost, which is happening at a given work condition. Actual cost, what is the actual cost incurred? Variance analysis is the resolution into the constituent parts and explanation of the variance. Explanation is very important here, right. Favorable and unfavorable variance, controllable and uncontrollable variance. So, favorable is what? In the case of cost variance, if the actual cost is lower than standard cost, it is favorable, otherwise it is unfavorable. In case of income variances like sales variance, etc., if your actual income is more than standard income, it is favorable, otherwise it is unfavorable. Fine, okay. So, types of variance. So, we will discuss primarily these variances, right, briefly. First one, we start with the first one, the material variance. So, material variance, there is material cost variance, material price variance, material usage variance, material mix variance and material yield variance, right. So, material cost variance is the difference between the standard cost and the actual cost, right. That can happen because of difference in price or difference in usage. This usage can vary because of difference in mix or difference in yield, right. So, we will discuss in detail all this. Then number 2 is labor variance. Labor variance is labor cost variance. Labor cost variance is the difference between the standard labor cost and actual labor cost, right? And labor cost variance may happen because of labor rate variance. So, I perceived that I will pay 50 rupees per hour to a labor, but my actual cost is 60 rupees per hour. So, there is a variance because of rate, and because there is a variance in rate, what is happening? The overall the labor cost is also going up, right? It is changing. The opposite is also possible, right? I assume that it will be 60 rupees per hour, my standard is 60 rupees per hour, but actually I am paying 50 rupees per hour. So, that is also possible, okay. Then labor efficiency variance, I assume that a labor will produce 10 units per hour, but actually it is producing 8 units per hour. So, when I will see that, right, that there is a difference, I need to find out what is the reason for it. So, I assume that the standard rate I am getting from my past experience, maybe how in other industry, in other competitive industries the labor work, that from there I am getting that idea that per unit per hour a labor should produce 10 units per hour, but in my factory he is producing labor production is 8 units per hour. So, then when I will look at this data, I have to think that how to improve it. Should I send my employees to training, right? Or are the competitors, the industries using some technology, new technology which I am not using, right? Have they made it more mechanized, right? Because of their productivity is high, and in my case it is less mechanized, less modern, so my productivity is low. So, this kind of questions should come up, and the management should seek answer for such questions, right? And it is as I said, it is a continuous process, right? It is a continuous process, and it needs to, do I need to employ more people, right? Do I need to employ more, ask for some qualification while employing new, make new appointments? So, this kind of questions should come up. Labor mix variance and idle time variance. So, we will discuss it. Overhead variance, overhead is, as you may know, we discussed earlier, overhead is the indirect costs, right? Indirect material plus indirect labor plus indirect expense is equal to total indirect cost, that is my overhead, fine. Now, this overhead cost, I planned for some overhead and actual overhead is different. What happens basically, see, in traditional manufacturing firms, right, the material and labor originally, right, I'm talking about 30-40 years back when this subject of cost accounting was developed. At that time, this material and labor was the more important component of the total cost structure. So, total cost I get how? Material cost plus labor cost plus overhead, right. But as the technology is evolving, work is becoming more automated, more mechanized, right. This importance of overhead is increasing, particularly in service industry, right. The overhead is a major component, so it carries lot of importance, right. So, with overhead we have discussed that this allocation is an issue, right. So, how I will allocate the overhead over the different products. If I have 3 products, right, and I have an overhead amount, right, 10,000 rupees, how I will allocate this 10,000 to 3 products, right. That is a one important aspect I need to consider, which I have already discussed before, right, if you remember. Now, I estimated certain overhead cost over the time, but my actual overhead I am finding when I am calculating it is different, right. So, how I will do it? I will get it overhead cost variance, right. Now, this overhead I can divide into 2 parts. One is the variable overhead, other one is the fixed overhead. Fixed overhead is which does not change over the particular time frame or production level, it remains same. What is variable overhead? Variable overhead which varies with level of production, right. It is indirect expense, but it is varying with the level of production. Now, this variable overhead expense I can separately I calculate. fixed overhead variance I can calculate separately. Then variable overhead efficiency I can calculate, and variable overhead expenditure also I can calculate. These are the three major classes of variances: material variance, labor variance, and overhead variance. Other than that, there are few other variances. As I said, that I can calculate the variance of income also, right? Variance of income also I can calculate. So I can calculate calendar variance, I can calculate sales value variance, I can calculate sales price variance, sales volume variance, and ultimately I can calculate the profit variance, right? I estimated that some profit I will earn, but actually my profit is something else. So why it is so, right? The question is why my profit is different from what I estimated under standard condition. That answer to that question is the key to my corrective actions, right, which the company is going to take for a better performance. So standard costing actually a very, very important tool for performance measurement and control, right? Okay. So favorable and unfavorable variance, as I said earlier, the favorable variance we denote it as the F, right, capital F. So arise when actual costs are less than the budgeted cost, or actual sales or profit exceed budgeted, right? And the opposite is just unfavorable. It arises when actual cost exceed budgeted or actual sales and profit are less than budgeted. So this is my favorable variance and unfavorable. As I said, the unfavorable variance and favorable variance, if it is within a manageable limit, because it is hardly match always, right? Some difference will be there because of some practical reasons, right? Because actual working condition and the standard working condition may not match, right? Most of the time they won't match. But if the variance is high, right, then it is a matter of concern, right? Then we have to take a serious look into it. And it is not only that unfavorable variances only we should take care of. Even if it is a very high favorable variance, that is also not a good sign. That shows that there was some problem in the planning level itself, right? At some, when we are planning the standards, there itself some issues may be there. So we need to look into that. So, okay. So what are the standard costs? So standard cost, the determination of standard cost is very important, because when I'm talking about the variance, right? So I am talking about the variance, so I look into the variance, why this variance is. But first, before going to the variance level, I need to look into that what is my standard cost, right? I must be very, very careful while fixing the standard cost itself. So the standard costs are based on carefully predetermined amounts used for planning labor, material and overhead requirements, the expected level of performance, benchmarks for measuring performance. Okay. So these are basically the benchmarks, and all the plannings are being done on the basis of the standards which we follow. So who does it? Actually, it is this exercise happens across the company. The engineers, the HR people, the production managers, the finance people, accountants, etc. They come together, they do brainstorm, they go through the data, right? Discuss, argument, counter argument, and this cycle. After several cycles, they set standards, and it is not always quantitative. There are some subjective matters are also involved. So certain decisions are depend on while setting the standard for the forthcoming year, right? Certain decisions are subjective and past experience of the managers and how successfully they are being able to foresee the forthcoming year. So they need to foresee from where the problems can come. Sometimes, like a black swan, it can happen like COVID. No one can foresee, right? No one have foreseen that COVID will happen and this kind of supply issues logistics issues will come up, right? No one have foreseen it. So in that case, many companies, they have seen large variance in that year. It happened in 2021 FY. So in 21, almost all many companies, they found a lot of the hospitals, for example, they did not foresee this kind of patient inflow. So their vaccine producing companies, they haven't foreseen, right, that such kind of demand. So there, for them, the variance may be favorable in sales income variances. I am saying sales variance may be very, very favorable. But the companies like, say, automobile companies or other companies, they face a lot of hardship in managing the raw material supply chain, labor supply chain, then revenue fall, right? Because of the shutdown and closures, everything is no sales. Sales is zero. So lot of pressure on revenue. So they face lot of unfavorable. But certain things you can't simply foresee. But certain things can be foreseen, right? So the managers can foresee the demand cycle, movement is economic cycle, expected movement in demand cycle, any bottleneck, expected bottleneck in supply chain, particularly if it comes from some other country, right? Large corporates, they source their material from across the globe, right? So they can foresee that where the problems can come up, and it is good to have a if their foresight is correct, becomes turns out to be correct, it makes the standard more realizable, right? But it is not an easy thing, right? It is done by a group of people from diverse background and experience levels, and a part of it is subjective. Okay. So standard versus budget. So standard is the expected cost per unit, budget is the expected cost for all units. So we discussed budget. If you follow the budgets, you will get it. So many times, as I said, that this doesn't work, right? There is a difference between actual cost and standard cost, and you need to find an explanation for it. If the difference is within the manageable limit, okay, that's fine, because that is the reality that has to happen. But if it is too large, then it may be problematic.